Recording started. All right, so everyone who registered will get the recording. I'm Ryan Nocera, if you guys don't know me. Oh, some people starting to get in here now. All right, good. I'm glad I waited a minute. Let's give people another 2 minutes, but for time purposes, let me just introduce myself. I'm Ryan Nocera. I'm a full-time trader. I run the meetups with Mitch Firestone, my business partner at Precision Trading Labs. If you haven't attended our meetups before, usually pretty damn good, I have to say. We usually deliver pretty high quality content. A little outside the box topic tonight, where we're talking about low dollar stocks, not to be confused with pennies. Really, like we said in the email, they're $20 stocks to, hold on one second, make sure everyone's mic's going in. They're $20 stocks all the way down to $3, most of them. Everything we're looking at tonight is in the double digits, majority of them anyway. Mitch is going to kick us off and go into, certain benefits of trading these, different setups that he's looking at, how to scan for them, why trade them, all the kind of good stuff. I'm getting into the actual strategy we use to trade them, to actually make money and protect yourself and all that kind of good stuff. I'll be back on here, and like I said, about a little bit. Let's let Mitch do his thing. And any questions? Feel free. You guys should have either a chat bar or a question bar. Feel free to ask her anything, and we'll try and get to it sooner rather than later. But if we get a good process going, then we'll talk first, then we'll get to your questions. But I promise I'll try and get to all the questions. We're pretty good at that. And then we'll get into some high quality trades. We'll look for some stuff for tomorrow, and we're going to look at some past trades that Mitch has had in the last couple of days with these. And then more importantly, we're going to look at some stuff that may hit tomorrow, may hit the next couple of days, and you guys will be able to review it and see if some of the strategies worked out. So it's going to be pretty cool. So give me a second here, and I am actually going to make my buddy Mitch here presenter, and then I will be back with you any minute, in a little bit. Mitch, I'm unmuting you, so if you got music going. Alrighty, Mitch, hopefully you can hear me. I'm going to make you a presenter in 1 second. Yes.
Hear me?
I can hear you.
All right, cool. All right, so let me share my screen here, and then I will go through a bit of introduction. Just give me 1 second, folks. All right, Ryan, can we see that chart that's in front there?
Yes, sir. Nice drop-based drop there.
That would be it. Okay. All right. Good evening, everybody. My name is Mitch Firestone. Pretty much what Ryan had said pretty much applies to me too. I am a full-time trader. I am a co-founder of Precision Trading Labs along with my buddy Ryan. And what we're going to do tonight is we are going to talk about specifically trading low-value stocks. We use the term cheap, but and as we know in the world, there's cheap and then there's value. And what, in a sense, we think about these it's more about value. I'm going to show you something in a couple of minutes about what goes on with penny stocks and really low volume stocks, and see about what you can see what the problems with those are. Not to say that they can't be traded profitably. I do it once in a while. They're a lot of fun, and when they work, it's a real kick. But having said that, they do present certain problems, and so I tend to gravitate more towards low value stocks but those that are highly liquid, so that they trade good volume, and you don't get into situations where you either can't get out of a trade or else things are just incredibly gappy intraday. So anyway, we're going to go into all that. Ryan's going to obviously go through a whole bunch of stuff later on after I get through, and he's going to go into a little more depth about how we trade. But I am going to basically do about a 2-minute introduction basically because of the fact that I'm going to show you a bunch of charts of trades that I had today and a couple of over the last week. And in order to understand what was behind these, obviously I should spend at least a couple of minutes just briefly explaining the approach that Ryan and I take to trading, because otherwise you're going to be looking at these charts and going, well, I don't get it. Like, what are you doing? So I'm going to basically just kind of very briefly go through it here. This chart here is basically, there's a pattern here. Okay, we see that there is you can see this bearish, very bearish red candle here. Price then going sideways, and then notice how price then very quickly, once it's through going sideways, drops very, very quickly out of this level here. It was in the level for a very brief amount of time, and then there was this series of very bearish red, long red candles here. And they go very quickly, and they go a long distance away. This is all evidence of an exhaustion of buyers. Basically, what happened was price came down quickly, it went sideways. For that brief amount of time, there was basically shares going back and forth within a relatively narrow price range, and then all of a sudden the buyers just disappeared. Essentially, there were no bids at the level where this yellow box is. Okay, there were only offers, there were only asks. Consequently, in order for trades to actually occur, one of two things had to happen. Either buyers basically had to return and elevate their bids in order to then keep buying at this level, or the sellers basically had to lower their offers, lower their asks, and move down the price chart until they found willing buyers at a lower price. In this particular case, the evidence was, in fact, that the sellers, in fact, went down the price chart, because you can see that this series of very, very bearish, long, bearish, fast candles show that they essentially just continued to go down the price chart very quickly, and this kept chewing up the bids, chewing up the buying power there. What this is really you're looking at here is the true mechanism of why price moves. It's an exhaustion of buyers or an exhaustion of sellers at a particular level. In this particular case, this is an exhaustion of buyers. To put it in economic terms, there's basically a supply of shares at this price level, but once price starts falling, there's no demand. Okay, this is economics 101. This is how we trade, and this is what's behind. This is what's behind all of our charts. So what the expectation is, when price falls out of this level really quickly and goes very far, if it meets certain criteria, there is the expectation that when price returns back to this level, you are going to see some repeat, basically an expectation that price will then fall from this level a second time. Why? Because there's an excess of supply up here, but as we found before, when it first fell out of there, there was no demand. So this was the setup here, and now if I now pull back on the chart, you then see that once price returned to that level, it then dropped out, and I'll zoom in on it now. But here was the level that we had before, where the yellow box was, and when price came back to that level, it then went up, drilled into it, for a short amount of time, and then once again there was an exhaustion of buyers, it then fell out and turned into a profitable trade, and it turned out to be a profitable trade to the tune of about approximately 3-to-1. So this is essentially the core principle of how we trade. We're basically looking for an exhaustion of buyers or sellers at a particular level. When price returns to that level, if it meets, roughly about a half a dozen different criteria, when it returns to that level, if it meets all that criteria, there is a high probability expectation that price will then repeat the behavior that was evidenced in the setup. We refer to this here as the setup. The point where we actually get into the trade, that's the trigger. And you can see that can happen. It can happen in 5 minutes. It can happen days or months afterwards. It all depends on the time frame of the chart that you're looking at. But anyway, that's the core principle of how all of our charts, what's going to be behind all of our trades and all the setups that you're going to see, both historically that I did this week and today, and then what Ryan's going to show you after I'm through here. So let's get into some definitions here now. First of all, why cheap stocks? You know, the obvious thing. They're low-value stocks, and so obviously, you know, the low share prices. So obviously, you know, you can get away with trading them with, you know, not chewing up a whole lot of your buying power. Obviously, if you're going to be day trading, obviously you first had to come up with the 25K to become a pattern day trader, unless you're doing, you know, a prop firm. But leaving that aside, obviously it requires a lot less buying power. These sorts of low share price stocks oftentimes will move quickly. So, you know, in other words, as a percentage. So, you know, to see something move 5, 10, 15, 20%, or even occasionally double or triple when you're talking about a $3 or $4 stock is not that unusual for those kind of things. And lastly, because of the fact that they are low value, they are low share prices, you can buy in quantity, where you might, in certain cases where you have a $200 risk profile of, let's say, per trade, you know, if you're trading, let's say, some high value stock, maybe you'd be buying 300 shares. On the other hand, if you're trading a $5 stock, depending on exactly on how you position, size, and manage your risk, and how your setups are constructed, you might be trading 2,000 shares, 1,500 shares. Consequently, your trades don't have to really go very far for you to make money. And so as a result, a lot of times, in a sense, there's always that trade-off between quantity and how far the price actually has to move. Well, when you're trading quantity, oftentimes you don't have to be in the trade very long for you to actually accomplish your goal. You know, time is money. Time is also time for things to go wrong. And so today was actually a real kick for me, because I hadn't actually spent an entire day doing nothing but trading these cheap stocks today, and they were a lot of fun. And because there were a couple of times where they just caught fire and moved, and I'll certainly show you a couple of these in a second. So anyway, so those are the main attributes of why these things are great to trade. And again, to be clear though, we're talking about trading stocks that are, for our definition, let's say between $3 and $20 a share, but also trade also symbols that are highly liquid. So they're trading at least, you know, preferably 1 million shares a day, but in fact, I'm happy to go down as low as 500,000, but really nothing less than that, because we find that things just work out a lot better. And in fact, I'm going to show you a little example of something here that went on here in the trade room today. This was something that one of my buddies in here was in today. He was in this CLBS, I don't even know what it is, I think it's some sort of biotech company. So he had bought, I don't know, somewhere around the 420 mark or the 430 mark, somewhere that. Now he trades momentum, but he basically asked me, he goes, well, where would you potentially get out of this trade? And so I basically came up at the time when he was in, let's say, around 430. I said, oh, it's probably reasonable that you could get out around 450, somewhere in this area, because this is an area that might act as a barrier to price. So he said, okay, great. So in fact, he got the price then and actually got up to that level. And what happened was, though, when it reached that level, he basically was looking at it, and he basically told me that, oh, I'm having a problem here. I said, well, what's your problem? He goes, well, I'm in, but I can't get out. I said, why is that happening? He goes, oh, I don't know. I guess it's kind of a little thin. And he was certainly right about that. So he basically ended up stuck in this trade for, I don't know, I think for about an hour and a half, and I think he ultimately, I think just cut it short because the thing started to pull back and he got nervous and everything, and I think eventually it did move up. But the problem was he was basically locked in this trade. And if you look at the top here, you can see the volume. It was 72,000 shares, and this is at 2:20 this afternoon. That's the problem when you get into these trades. There used to be a commercial on TV for a Raid, which is a pesticide, and they have the cans of stuff that you spray, but they also have these. They had something, I don't know if they still have it, but they refer to as the Roach Motel, and it was this cardboard box with glue and a pesticide and something that would attract roaches, and they would crawl in and eat the stuff and get glued to the thing and die. And the credo, the tagline of the ad was, roaches check in, but they don't check out. Well, in fact, that can be what penny stocks are, that you can get into a trade, but then you end up locked in it because you can't get your price, because all of a sudden the liquidity dries up. And what I'm going to do is I'm going to show you a couple of examples here. So what we're looking at here is the market, the depth of market here for a couple of different stocks. Here's the one, the CLBS, that he was looking at, and here is something else that I was trading today. Notice that they're both low single-digit stocks. $3.25 was the current price of this one here, and this one was $4.50. Okay, but notice the depth of market here. Notice that you got a couple of $100 share blocks here. Right down here, there's actually a 6,300 share block, although that's a bid, but that's about 25 cents lower. And in between, you've got basically just got a whole bunch of spaces. Where over here, for this particular stock, it was $3.25, so actually a buck lower than this other one. Notice how much thicker the depth of market is on this one. Yeah, there's some holes here and there, but they're 3 cents, 4 cents. There's reasonable volume. There's 1,000 shares, 500 shares. This thing on the left is what I refer to as Swiss cheese. It's basically just holes. And the problem with Swiss cheese is, A, you get locked in the trade, and B, if in fact you get stopped out of your trade, because let's say if you use a stop market order, because you're basically trying just not to get locked into a trade, you may think you're going to take a 20 or a 30 cent something, where let's say if you thought that you were going to get out here at $4.50, but if all of a sudden, or let's say you thought you were going to get out at $4.40, but if this thing is Swiss cheese, you may not get out here till $4.28 or even lower, if depending on how the holes look on this. That's one of the problems of trading something that's really thin and really illiquid, like this CLBS here. There's nothing wrong per se with trading it, but you have to be aware of what what's the what the potential problems in doing that are. So what I'm going to show you here is basically how we go about looking at and finding stocks that in fact are actually worth trading. And there's a couple of ways that we can basically go about and do this. Let me just bring up a couple of charts here. Now, depending on exactly what you use in terms of how you trade, some people just use e-brokers. Some people are actually using, a direct access platform. But one way or another, basically people should, always have access to some sort of simple kind of screen. And the way we go about it here is a couple of ways. You can either, like I said, use your direct access platform and basically just set up a very simple screen here, And this one, the one that I'm about to show you here is actually something that's very simple. It's again looking for things that are between, symbols between $3 and $20, looking for an average volume a day of about 450,000 shares. The reason I use 450 versus 5 is if it comes out to 490, I'm not going to get too exercised if it's 10,000 less. So I set it for 450, and this way, like I said, though, my real preference is to really have it come up with at least $500,000. And that'll give you a nice, pretty juicy list of stocks to pick from. Now, within that, of course, there are other considerations. Some people will say, well, you should absolutely, of course, look at the ATR, and we would certainly agree that you want to have something that moves sufficiently. You don't want to have something with an ATR of 7 cents or even a dime or something generally. But on the other hand, you don't want to get too hung up on the ATR, because the way I think about it more is I really think more about relative ATR. If you've got a $5 stock, but it's got an ATR of, let's say, 20 cents, well, that's actually not too bad, because of the fact that that's a 2.5% move on average per day for basically for 14 days if you're using the default settings for how ATR is constructed. That's pretty reasonable. And if you're going to end up trading, let's say 1,000 or 2,000 shares or something, and you can see a 20-cent move on it, that actually starts to add up to real money. So I tend to think about ATR more in terms of relative ATR. In other words, the ATR as a percentage of the price of the symbol, as opposed to just saying, because of the fact that if you just plug in a scan and you say, well, look, I want to see an ATR of at least 50 cents. Well, if you do that, and that's actually how this this scan was constructed, and then I thought about it, and I said, well, in fact, let me also try one that doesn't have ATR in it. Because if you do this, then in fact, what's going to happen is you're really not going to come out with any of this. You'll come out with very few or no single-digit stocks, because of the fact that it's not too reasonable to think that on average for basically 3 weeks you're going to come out and average a 50-cent move on a $5 stock or even a $10 stock. That's just not going to happen. So consequently, once I did that and I thought about it, I said, okay, well, let me just stick with volume and price and no ATR. And once you do that, we ended up with, I ended up with, a nice selection of stocks to check on. And what you do is you just run this thing every day, and you can just come up with these. And obviously, from one day to the next, the list isn't going to change that much. But there's always new symbols that kind of drop in and leave. So each day I run this thing and come up with it, so that I have a universe of kind of cheap stocks. If you don't have this kind of thing on your platform, a very easy way and a free way to do this is using something called FinViz. I'm sure a lot of you are familiar with this, and they have in there their stock screener, and you can actually, if you just register and have a username and a password, you can set up, all kinds of scans, and you can set up to 50 different scans, and you don't have to pay a dime for this. The one downside of not paying, if you're just using it for free, is if you come out with a large list, you can't export it for free. You can, I think, export a list of, I think, up to 50 symbols. Anything more than 50 symbols, and then they say, well, okay, you need to, pony up and actually, pay the premium. But at the very least, you can run these scans, and you'll just have the symbols in front of you, and you can access the symbols. You just can't necessarily export them. But if you do this, let me get the criteria here. And basically, this was just a very simple thing of looking at, and let me see, let me get the right scan here. In fact, let me just build a new one in front of you here. That'll be easier. So if you want to basically build this scan, what you would do is you could basically just tell it for your price, you start out with over $3. In fact, what you could do is basically just go, they actually have a range here of 5 to 20. So you can start out doing this, and what I do is you can just do this in pieces. You can do the 5 to 20 one, and then just do the incremental ones underneath. So, so you do the $5 to $20 one, basically telling it on the volume. Let's say do over 500,000 shares. Okay, and at that point, you come out with 189 symbols here. Just doing this nice little thing, and what you can do is at that point just go up and save it, and you can just run this screen every day. Another screen that I run and that I'm very fond of is volume breakout. And what this is, again, you basically set your price level to what you want, and again, let's say for the purpose of using FinViz, using the 5 to 20 range. And then relative volume, basically what this specifies is that it's running 5 times its normal volume. And that's actually adjusted intraday. So in other words, if, after the first hour, if the thing normally was going to pop out, let's say 100,000 shares, if this thing is trading 500,000 shares, it shows up on this screen. So for today, there were basically 29 symbols that met that criteria. Well, generally, when you have symbols that are really flying in that regard in terms of popping on volume, there's usually something going on. The stocks are not just flatlining when they're doing that. So that's a great key in terms of finding things that are really moving. So again, what you can do is you can set up these screens, and then once you have them, you can either just work directly off the screens, or if in the case, if you, let's say, are a little more sophisticated about it, what you could then do is pretty much basically just drop all of these symbols into your watch list in TradeStation, which is what Ryan and I use here. This is what's referred to as a radar screen, and it's just an Excel spreadsheet that updates in real time. So once you have these things, you can then sort them for any sort of whatever criteria you want. So right here, obviously, you're starting right here at the low price stocks that are $3. Here you can see the change from the open versus this is the net change from the previous night. This is the net change from the open. You can make sure that what you're trading is highly liquid today, and you can see these are all ones that are very, very low volume. So what I would tend to do is, even though their average volume is, let me just make sure this is set correctly here, daily chart. So what I want to do is basically gravitate towards the symbols that are high volume. And once this thing finishes sorting, this again will put everything in order, and then you could work off of that. So that's a couple of simple ways that you can basically find what I refer to as these value, the low value, the low share price stocks. Again, like I said, even though it might be fun to trade this one that pretty much averages 61,000 on a daily basis, I wouldn't be thrilled with that. On the other hand, today, this thing traded at 525,000. So obviously there was something up with this. So one of the things that you do is once you load the results of your scan into your watch list, and if you've got a symbol indicator that shows its average volume versus its volume, you can just eyeball this and go, okay, well here ATEC put up about 9 times or close to 10 times its average volume. Here's OXLC, it put up what, triple. And so that's one of the good ways that you can find these cheap stocks. By definition, they're liquid because they're all averaging at least 500,000 generally, and then you can find ones that are actually on a volume breakout. So that's another way that we basically find candidates to trade. All right, so let me bring up some of the things that I was working on today and a couple of days ago. And so what I did was I basically took a series of snapshots, a series of screenshots as I found setups, basically using these particular screens, just simply, identifying volume breakouts, looking at things that are fast moving. Another scan that you can do within your platform is to basically set it for things that are moving fast. And in TradeStation, I have a screen that basically in the last for the last 2 minutes, what are the stocks, what are the symbols that are moving either higher or lower the quickest on a percentage basis. So this thing dynamically updates. You can do those sorts of screens, and FinViz has that as well. They have a version of that. So again, you don't need a souped-up platform or any sort of fancy, anything fancy. Basically there are free tools that will allow you to screen. So to sum up, though, on that, you want things that are liquid, that are, again, $3 to $20, that have a reasonable relative ATR. So you want to, feel that, okay, if it's got a relatively low if it's got a high ATR of, let's say, 80 cents or $1, then you don't really have to think about it in those terms. But on the other hand, if something's got a 15 or a 20 cent ATR, but that represents, let's say, 2, 3, 4% of the share price, well, then that's something that's worth trading. And then again, you want to and then at that point, then you want things that are actually moving intraday that way, as well as having a volume, oftentimes a volume breakout. So let me show you something that I had today here. So what I did was, like I said, I took a series of screenshots as I found setups and as the setups developed. So here was BSPM. That's some pharmaceutical company. I can't remember what it is. I believe it's some sort of biotech company or whatever. And so I found this. Again, there was this exhaustion of sellers that occurred at this level, as evidenced by this this big green candle that came firing out of there, and that was evidence of essentially of an exhaustion of sellers here. So there's the expectation that there is still excess demand sitting here, and excess demand, of course, translates to base bids, institutions or retail traders that still wanted to buy but never got the opportunity because all of a sudden the sellers just disappeared, and at that point the buyers that were not disciplined, or they decided, listen, we just have to get in come hell or high water, they got in and just ran up the price chart. But there were others that sat back here and said, well, look, we want to buy, but we want to buy at $2.70. We don't want to buy at $2.90 or $3. So if the price returns back here, then I'll buy. So this is the how the setup developed. So this was the setup here, and when price returned to this level, notice that it basically just tipped right off the front there. This one happened to work perfectly, and then started to move up. This thing I have on the side here is essentially another way to use a Fibonacci tool. And what it does, instead of looking at retracements, what you can do is you can actually set your Fibonacci tool up to basically measure risk and reward. So if this was my level here, and this was my stop right here, which my stop would be 1 penny under this bottom line of my level here. This is my risk parameter right here. So I'm getting in at 271. I'm getting, and if the trade doesn't work, I get stopped at 264, 263. As it happened, this thing came right down and started to leave. And so there was the entry. It came up to here. I took 2/3 of it off and said, okay, well, the market was starting to show strength. The biotech sector was starting to show strength, so I thought maybe this thing had more room to move. And of course, the first thing it did is it pulled all the way back into my zone, but I decided just to let it run here because this level had basically not been touched by in terms of any meaningful extent. Basically, twice the level was kissed, but nothing ever went into this level. So it came up, it dawdled a little, it came back, it went, and then all of a sudden it just ignited, and that's where I got out for the last third. So I took 2/3 off of here, and I took off the last third here. So this was actually a really nice trade. But again, that same formation here, and this was a $2.70 stock. My risk profile for most of my trades is I allow myself $200 worth of risk. For these stocks, I actually drop that down a bit. I'll typically do closer to 100 or 125. So in this particular case, I traded, I believe, 1,400 shares on this. And so 1,400 shares with a level of about 8 cents would if the trade didn't work, I would have taken a loss of approximately $112. But instead, of course, it worked very nicely, and so I made some money. And then, in fact, right here, after I was done with this trade, I did follow this thing. There was my exit, but in fact, I actually followed this thing throughout the day. So right here, another level got created, and then right above here, as this thing was moving, another level got created here. I hadn't actually drawn it, I guess, at this point. And eventually, actually, I'll show this to you at the end here. I realized I forgot to do a screenshot on this one. But in fact, the price actually did come back to this level right here, but I didn't take the trade because I was involved in 2 other trades here. But in fact, it actually did come back to this level again. So let's see here. All right, so here's another inexpensive stock. This was a $15 stock. I believe this is a gold stock of some sort. And again, the same sort of formation. This energetic move up, price went sideways, price exploded out of here, and I was basically just waiting for price to return to this level with the expectation, again, that price would then reverse and start to head up, mirroring that explosive move out of here, which was essentially the exhaustion of sellers here. So right here, it came back, came down to the level, went a couple of pennies into it, and then reversed. It came up, thought it was going to go further. It didn't. I gave it a chance. It came up, it went, and eventually, right here, I just decided to call it a day. I gave it a shot, and 3 times it went up to this level, and 3 times it just didn't want to go through. So I said, okay, I'm done. So I took my 18 cents. And again, I had 1,500 shares on this. 18 cents times 1,500. Again, that was a reasonable pay for pretty much for drawing two lines in a yellow box here. This is an ETF for I believe for natural gas. It might be the inverse ETF, I think, and again, similar situation, waiting for an exhaustion of sellers occurred here. Price popped out of here energetically and went a decent distance away. And the expectation when price would return to this level, it would then reverse and come up and start heading back up again. So right here it came down, tipped off, started up. And at that point, basically the day just kind of ran out, and so I let it run, and basically the clock ran out on the day there. Here is another trade I had. Again, $5 stock. Again, this energetic move up. Price went sideways. Price exploded out of this area. I guess I was busy. I neglected to do the before picture, but again, price came into there, and then it started heading out, and I think I just killed the trade roughly at about 150% here. And this was something I had, and I guess this was another thing that I had, I guess, last week. Again, similarly, a $4 stock. Again, the expectation that once price came into this level, it then came back down, drilled into the level, and then headed out. So you can see the way we trade, and again, utilizing these small stocks. But notice up here, the volume, 2 million shares. And in fact, if we just quickly flip back to all the ones that I showed you just now, volume, 5 million. Volume, 11 million. Okay. Volume, 8 million. Actually, that's the same one, sorry. AU, 3.5 million. Okay. Notice that these are all liquid. So if you're going to trade $3 and $4 stocks, no problem. But trade the ones that are high volume and liquid, because first of all, you're not going to have won't have a market depth that looks like Swiss cheese. If the trade doesn't work, you're not going to suffer tremendous amount of slippage by thinking you're going to take a 30-cent loss instead of taking a 60-cent loss. And frankly, most importantly, the way we trade and the way we're looking for these areas of price imbalance, where again price explodes out of here the first time because of the fact that there's an exhaustion of sellers, so all you have here is demand but no supply. Well, these trades work better when there's high liquidity. Supply and demand hold a higher probability of the time when in fact there's liquidity. So consequently, if it generally holds a lot better than if you're looking at this thing that I showed you when we first let off here. And you can see the volume on this was 73,000 shares, and you can see this is at 2:20 this afternoon. So I'd be very surprised if this thing even got to, probably never even got to 100,000 shares by the end of the day. These trades just, and this core principle of how we trade basically just works a lot better in high liquidity situations. So anyway, I really just wanted to introduce the concept of the brief concept of trading these symbols that are highly liquid. A very brief introduction to how to screen for them, and basically then showing you essentially how before and after pictures of how setups and trades actually arise from them. And the one last thing I will show you here is, and then I'll hand this over to Ryan, is the last thing that is actually also really good about this is, and let me just bring this down here. The other thing that I would assume, for those of you that are trading, I'm sure you probably have some sort of news feed, but real-time news also feeds into this process. There are any number of, throughout the day, there's just a constant stream of news about about all these symbols. Now I use something that I actually pay a few dollars a month for. It's something called Trade Exchange. It's actually a real nice tool here because of the fact that it's giving you a tremendous amount of news in terms of individual symbols, but then they actually also tell you about things that are in the media. So for instance, when things are being discussed on CNBC, they'll say, okay, Kramer is flapping his gums about this or that, when John Najarian right now is actually pointing out unusual options activity. So I actually use this thing and get, usually over the course of a week, I'd probably get a good 3 or 4 trades off of just this thing alone. Here you can see right here, there's these are all aftermarket, but here this is all stuff during the market hours. A volume pop on this symbol. Well, when that kind of stuff happens, I'll go and throw it into a chart and see what it looks like. In terms of trading these cheap stocks, I oftentimes really don't care all that much about why something is moving or even what the typical reason that people might think, what kind of news they think it might be. It just gives me an excuse to look at another symbol. So I don't care that somebody says, well, this drug is being approved, or they got a bad review by the FDA, or in other words, something which might seem overtly positive or overtly negative. I'm not necessarily looking to take that bias. But what it does is this kind of news thing just gets me to look at a symbol. And if you have a good core methodology, that's really all you really need. You don't really have to be told, oh, you should be thinking long or you should be thinking short. Just anything that gets you to look at another symbol that you might not normally have looked at, it's a good thing. So anyway, I just wanted to leave you with that. And lastly, if you don't have one that, you know, if you don't use a real-time news thing, and let's say you don't even feel like paying for one, there's something called Financial Juice, and this one's entirely free, and it's real nice, and you should check it out because, and you can see here it'll give you. If you're trading forex, it'll give you things about currencies. Here I have the thing for equities checked off here. If you're trading futures and commodities, you can have it screened specifically for that kind of stuff. And again, this is entirely free. And if you just have this thing sitting next to you as the day is going on, again, you'll be pointed at symbols, and you'll be pointed at things that are moving. So anyway, that's about all I got here. So I'm going to hand it back to Ryan, and thanks very much.
Hey,
Ryan,
Mitch.
take it away.
Yes, thank you. I'm going to get into some strategy stuff and really get into it using some examples. Two things are actually, Mitch, that we had one question here that I wasn't positive of. If you could bring up your scan real quick.
Sure. Give me 1 second here.
Gotcha.
Can you see this now?
I can see it, yep. So
okay.
that column you have that says last two, that's about the change in price, correct?
You mean right here, or down here?
Right down there, yep, right next to net percentage.
Yeah. Yeah. Just to be clear, where it says last one and last two, all that is, it's the last price. The reason that it says last one and last two is because I actually put it in two different places. I have it here leading off, and that's so that, you know, as soon as I look at the symbol, I can see it's a $15 stock, it's an $8 stock. But then I also throw it here. And right here is the net change and net change percentage based on the previous close the night before, okay? But then, and then I put that here. But then to its right, I have the net change from the open. So for me, if a stock, let's say you have a $4 stock, and it gaps up to, let's say, $5, but then over the course of the day, it then starts to give back, and it ends up at 4. Well, from the perspective of the change, the regular traditional net change, it's up $1. But from the perspective of the net change from the open, it's actually down $1. And for me, that's generally more important during the trading day. I actually generally care more about how something is trading during the day than the fact that, yeah, there was a huge gap. And of course, the gap certainly has significance. But at the same token, how something is actually trading throughout the day, I actually consider generally to be more important. So again, the reason for this last, so the second I threw in another column that said last, well, then it calls this one last one and last two. But you can see it's exactly the same thing. It's just the last price. And this way I can see, okay, here's the net change, here's the net change from the open, and here's the price. And it's just another way of, you know, looking at the information. All right.
Yep. One other question, Mitch, that I can probably handle it is just, would you suggest this kind of trading this as a new trader? If you want to hit that, I could take care of it. But would you suggest these for a new stock trader? I'm gonna just go ahead and speak for Mitch, and I really think these being really cheap, it's actually a really good place for a new stock trader to start because you can put on a small amount of shares. Now, be mindful of the pattern day trader requirement. Pattern day trader requirement just means you need at least 25 grand in your account. Otherwise, you're limited to something like 3 to 5 trades every week, and it's renewable every week. So you got to take those amount of trades. You hit your ceiling, you got to wait a couple of days to be taking them again. Now, that being said, if you're trading with just and one to a couple $1,000s in your account, and you want to get your feet wet. I mean, Mitch, get your opinion too, but anywhere from $3 to $20, be able to put on just 100 shares of stock and risk $20 to make 40. That's a very ideal place for someone to start trading. It's not trading 100 shares of Apple or 100 shares of Netflix, and they're $100 a share. Some people I've heard of, trading Tesla when they just start out. Really trading some of these names, as long as they're not the Roach Motel description that Mitch gave in his presentation, and they're these highly liquid, $10 stocks. I think it's a very ideal place for someone to start trading. Mitch?
Yeah, no, I would definitely agree. I might consider not necessarily trading the $3, $4, $5 stocks, just because of the fact that they will tend to move oftentimes disproportionately in relation to their share price. And of course, when you're on the right side of it, woohoo! It's the world's a beautiful thing. But on the other hand, when these things ignite, and you're on the wrong side of it, you're just going to you'll get taken down. Now, you'll get taken down in a sense reasonably, that you won't suffer slippage and all that stuff. The one caveat, though, I would also throw on this is that if you're going to trade these sorts of stocks, and again, we only have basically an hour here. If you do you have my screen still up there?
Yeah, I do.
Can you still see my screen? Okay, fine. Let me just blow this up very quickly here. Let me just enlarge the fonts just a little here. Okay. Why is this not helping me here? Oh, here we go. Okay. If you notice in my watch list here, in addition to the data, I also have the industries. And if you go through this thing, in fact, let me just alphabetize it. Okay, you're going to notice that there's a fair amount of biotech in here. There are a lot of these cheap stocks. These very low double digits and these single digits. A lot of them tend to be in the biotech area. Well, if you even look at the real-time news, even today, there were any number of announcements that had to do with the FDA either giving the thumbs up or thumbs down about something, or some company said that there wasn't any initial efficacy for their phase 2 trial. Well, that sent some of these stocks flying, one direction or another. And it's one thing if you're an experienced trader. It's another thing if you're first starting out. So if you're going to do this, and you're going to use, let's say, these sorts of stocks, I would strongly suggest limit yourself to the I won't call them the boring industries, but kind of limit yourself to, don't be playing with biotech stocks, regardless of how liquid they are intraday, because you just never know what somebody's going to say. So that would be my my one caveat about that. All right.
All right, cool. Thanks, Mitch. One other question about these getting halted. I think any stock can be, any product can be halted at any time by the exchanges, right? So, I mean, it happens, right?
Well, yeah, but it will happen. It happens more often with these low price stocks, but really where it happens more often is with the illiquid ones. Now, I think in my case today, in that nice trade that I had with whatever it was, PBMS or whatever that thing was, I think it might have gotten halted at some point. But generally, these aren't necessarily getting halted as much. The reason that happens is because supply and demand. And what happens is when you have a situation where the market depth looks like Swiss cheese, that's why price rips through, because all of a sudden it goes from, let's say, $3.25, and when the next stop up the ladder is 360, well, it just immediately jumps from 325 to 360. Okay, when you get those kind of very rapid, sporadic jumps, that's what I mean, in terms of the rules of the exchanges, in terms of the Lulus, limit up, limit down, or the circuit breakers, those happen more often with the illiquid stocks than the ones that are highly liquid.
Cool. I think that answers it, Mitch. We'll put some more. You know what? I'm only gonna have enough time to look at maybe one or two setups. If you guys have a low dollar setup, like something in the below 20, you want me to look at, throw it in the chat box. Like I said, we only got a couple minutes left. I'm gonna go through one or two stocks. We're gonna put together a summary of tonight, and then we'll send that out to you guys probably tomorrow. Let me go through one of the low dollar stocks. Two of them I was reviewing with the scan that Mitch did. Oh, sorry, this is an options workspace. Sorry about that. All right, let me get over here. So one of the ones I was looking at that I found was a stock called SUM. Give me 1 second. Let me fix this, and I'll try and be as quick as possible, right? So I found a 30-minute chart, and I saw, you guys see here, right in the middle. Mitch, I'm going to leave your mic on so you can we can call it quits. So just so you know about that.
Sure.
And everybody see this little area here where that little gap is? Notice here we had that strong candle. Then we got those two 30-minute bars, right? Price kind of traded sideways. And then just a sea of red. Everybody see that? Straight down. Straight down. I like to see that, right? I especially like that little gap there. And then I really want to take my trade around this little guy. More importantly, besides the little gap, that sea of red is really important to me. I actually did it all already for my own analysis over here. And you'll see this, I wrote sea of red, and I threw two trend lines. Now, the trend lines aren't important. What I want you to see is the sea of red that happens from that little area right there. So if I throw two lines around there in the yellow box, that gives me a risk of about 11 cents. 12 cents once because I'll do a penny on the other side, right? So for a 12-cent risk trade on an $18 stock, let's just round it up to 19, and a fairly high probability setup on one chart on one stock, right? Now I have this other guy right here that looks like it'd be waiting for tomorrow. Now here it's a little bit harder to see for the untrained eye, right? But I wrote here a little note that price is kind of trading sideways in here. You just see that big move down and then the move back up, right? That doesn't interest me, right? I just see this little sideways action. But then you'll see in the yellow box, I highlighted that one single candle where price kind of traded sideways. And here, I could even drop this down to like a 15. I just didn't want to confuse anybody, right? So there's a 15-minute chart. Notice there's three candles trading sideways almost perfectly. And then another sea of red. Something's interesting happening there, and if I'm saying that there's a footprint here, or the market has some kind of memory of some kind, is that when price returns to this area, we'll look to see a mimic of what happened before. And this looks to be something for tomorrow. I like this. It's a 15-minute chart, nice little day trade, nice move away, definitely 2, maybe 3-to-1 risk reward behind it. I have to see what the entry looks like, but tomorrow morning, we get to see a steady move into this area. I'd look to take a trade around here. And that's a nice little setup for tomorrow. Low risk, high reward, exactly what I like to see. This zone here looks to be about 14 cents. Let's say we do a penny on the other side, it's about 15 cents of risk. Again, $18 stock. I can afford to buy 1,000 shares of this and possibly, well, that's $180 of risk. Let's say I'm going to buy 500 shares, do $90 of risk. I know a lot of penny stock traders out there risking hundreds, sometimes thousands of dollars in their account on a stock that's, low probability. Another one I was looking at was, let's send me over to this workspace because I had set up here. That actually happened already. Now it happened today, right? This is a 195-minute chart. Again, I highlighted in yellow there, that little sideways action. And then that nice drop. You see that long red candle, right? And then I have this little area down here in blue. All I wanted to do with that is I want to use that as my target. I want to have some place where I can get out, which seems on the front end to be a higher probability setup, right? So we have this. Here's where our entry will happen, right here. I'm using that whole area to make sure I get into the trade. Because you see, I didn't know where price was going to go. Price wicked into here, and then it's made its gentle descent from 11.27 to it closed today at about 11. It was a little lower than that. But if you're in this trade now, just to be transparent, I'm not in this trade. This is just for purposes of the webinar. Huge move down from here, a nice move into it early this morning, and then a back off, basically on the next candle right there. Move down, close below, but let's see where it happens tomorrow. I really want to get down into this area where price is really beat up. If it can get down into here, I'll risk 27 cents to make 71. That's a nice trade. You know, that's, let's see, it's about $135 on 500 shares to make 350. Take that trade all day long. And if you have the means, really, this could actually run. Since this is so beat up down here, I don't expect anything to hold up. And I really think this trade could go much further, maybe even $1. Anyway, I wanted to show you two good setups. This one's happening and in progress right now. Maybe I'll try and include that as an attachment. And again, this is just to prove a point, not to give you any a trade or anything like that. So it'd just be for educational purposes. But between this and that, we have two really nice looking setups that a trader could take for a very low risk on a low dollar account. And that's really what we want to get across here with these low dollar names. We just want to make sure that they're, like, I can't convey enough what Mitch said about being highly liquid, because the last thing you want, I've been in trades that you just can't get out of, that you're just, it's so illiquid, you can't get out. You know, and that's not a good feeling when you're either sitting on some profit or you've accepted that you're going to take a $100 loss and you watch a $100 loss become 300 really fast. It's pretty uncomfortable. So be careful with that and follow the guidelines. If you're going to have this video, follow the guidelines Mitch laid out in that in the beginning of the webinar on why trade using such and such volume, a certain amount of shares going, and why he uses ATR and all this other good stuff. Mitch laid out a really good case for trading these and why it's worthwhile. So let me just give a quick glance at the questions, and let's see here. See if I missed anything. And if I did, or if anybody has any questions, we're about wrapping up, so I'll try and get to some questions if anything. Time frame is the chart. Last two. Label. Time frames. Mitch, we had a question about time frames, and then we'll call it quits.
Yeah. Sure.
I kind of look at these. You'll notice I did a 195-minute, which is a higher time frame, and then I also looked at this in a 30 at 15. You have anything to say you want to add about good time frames to trade with? The only thing I can think of is the actual dollar risk and the risk of gap risk holding it overnight. But if you want to just end on that, that's a pretty cool ending, I think.
Yeah. All right. Is my screen up there now? What do I need to do?
1 second, and I will make that happen. Hold on.
Okay. Basically, for all of the those trades that I showed you a few minutes ago, they were pretty much all
just hit the thing and
lower time frame.
Sorry,
they were all kind of lower time frames. They were all kind of like 5 minutes. But in fact, I am going to show you one thing here, though. In fact, I'm going to use my buddy who was asking me about his chart earlier in the day. We refer to the way we look at price. A time frame is essentially a lens. The price is moving the way the price moves, and and the price action does not change. But if you're looking obviously at a daily chart or a 5-minute chart or a 60-minute chart, obviously the chart's going to look entirely different. That's the lens. And the way most people look at these charts, of course, is using time charts, 5 minutes, 60-minute, 15-minute charts. And that's one flavor of lens. But there's in fact a second flavor, and that's essentially using not time as the not using time, but in fact using volume. Because this is what, if you had looked at this CLBS that my buddy here was in today, and then where he got stuck in the trade, this is what this chart looked like in a 1-minute chart. This is what it looked like in a 10-minute chart. It's all gappy. You really can't find, I don't see these levels here. And one of the things that I find when I'm trading these low-cost stocks, and it's both low-cost, liquid or illiquid. I mean, a lot of times, like on some of the trades that I showed you, they were all time charts. But a lot of times where $3, $4, $5 stocks, even when the ones that are liquid, I will oftentimes convert them to share charts. And instead of each bar representing the price action for a particular amount of time, in the case of using a share bar, it's the open, high, low, and close of every, let's say, 50,000 shares. So in this case of the CLBS that my buddy was in today, I could this chart kind of looked like garbage here. But once I turned it into a share chart of a 5,000 shares, then I was able to actually see this level here, where I couldn't see it here before. So if you have that capacity in your trading platform to look at things either in terms of shares or ticks, sometimes looking at it with a different lens again will kind of show you something sometimes different. Here's something that I was looking at earlier last month, CSLT. And I guess I was looking at this in a 200,000 share bar, because when I started to look at this thing in a time chart, whoops, sorry, too many charts on the screen. Here we go. So this was a 60-minute chart. And the thing is, by looking at this in a 60-minute chart, the only thing I see here is this huge wick. And no matter how much I brought this thing down in terms of time chart, even if I brought it down to a 5-minute chart, it was just this huge burst off of the open. But the second that I turn this thing into a share chart, then all of a sudden that huge wick broke out very nicely into something that I could define a point of origin of this strong move. And as Ryan very nicely explained before, again, this area is where we find these high probability trades. So sometimes changing your lens either to a share chart or just playing with the time frame will oftentimes help to identify the point of price imbalance. So I know a lot of people, when they learn how to trade, and they say, oh, you could look at 15-minute charts or look at 5-minute charts or look at 30s, but don't really start changing them, because otherwise that's cheating. And I have to tell you, that's BS. The only thing about your charts is that it's supposed to highlight something that you're looking for. And really what you're looking for is the point of price imbalance. That's why price moves. And if by changing the lens, it helps you see something clearer, there's nothing wrong with doing that. And so as a result, like I said, a lot of times for these $3, $4, $5 stocks, I'll utilize share bars rather than time, because a lot of times what happens is it just highlights the price activity in greater detail, and it basically just leads oftentimes to a better trade, makes things more visible. So anyway, that's it.
Cool. If anybody has any questions about share bars, just send it to us. We can recommend either a broker or some free charting platforms that if yours doesn't have one, you can choose a web-based one, and at least they can change you to share bars for it. I have a good one I can recommend to you guys if you want to just play around with it. If you have TradeStation, you can use share bars and ticks. Anyway, let's call it a night. I hope everyone got some really good value out of this. We went through a ton of stuff in a short period of time. Like I said, we'll write up some kind of summary about the whole deal, and then we'll have the recording and we'll send that to you. And probably try and get that out to you tomorrow. One of us should have enough time to roll it together. And thank you for coming. And any questions, you can just reply to the email that you get tomorrow and send your questions on over to us. One of us will answer you. Have a good night. Thanks for coming. Appreciate all of your attention. Mitch?
Thanks so much. Really appreciate it.
Have a good night, guys. Take care. Bye.